This presentation is for Chapter 10 Investments, exercises S10-2, E10-10, S10-3, 4, 5, and 6. You should pause the presentation and complete these exercises and come back and check your answers. On January 1st, 2018, Chaucer's Restaurant decides to invest in Lake Turner bonds. The bonds mature on December 31st, 2023 and pay interest on June 30th and December 31st at 4% annually. The market rate of interest was 4% on January 1st, 2018, so the $90,000 maturity value bond sold for face value. Chaucer intends to hold the bonds until December 31st, 2023. The problem asks that we journalize the transactions related to Chaucer's investment in Lake Turner bonds during 2018. First, you would record the purchase of the bonds on January 1st, 2018 by debiting held-to-maturity debt investments for $90,000 and crediting cash for the same amount. Chaucer would record the semi-annual interest received on June 30th and December 31st by debiting cash and crediting interest revenue for $1,800. The interest revenue is equal to the face value of the bonds, $90,000, multiplied by the interest rate of 4% and multiplied by 6 divided by 12, since the interest is paid semi-annually. The investment in Lake Turner would be reported as a long-term asset on the December 31st, 2018 balance sheet. League Up and Company owns vast amounts of corporate bonds. Suppose League Up buys $900,000 of Cocoa Corporation bonds at face value on January 2nd, 2018. The Cocoa Corporation bonds pay interest at the annual rate of 8% on June 30th and December 31st and mature on December 31st, 2022. League Up intends to hold the investment until maturity. The first part of the question asks, how would the bond investment be classified on League Up's December 31st, 2018 balance sheet? These bonds would be classified as a held-to-maturity investment in long-term assets. The problem then asks that we journalize the receipt of the final interest payment on December 31st, 2022. The semi-annual interest amount is equal to $900,000 times 8% times 6 divided by 12 equal to $36,000. The entry would include a debit to cash and a credit to interest revenue for $36,000. Next, we record the disposal of the investment at maturity on December 31st, 2022 by debiting cash and crediting held-to-maturity debt investments for $900,000. On January 1st, 2018, Bark Company invests $10,000 in Roots Inc. stock. Roots pays Bark a $400 dividend on August 1st, 2018. Bark sells the Roots stock on August 31st, 2018 for $10,450. The problem states that we are to assume that the investment is categorized as a short-term equity investment and Bark Company does not have significant influence over Roots. First, we would record the purchase of the securities on January 1st, 2018 by debiting equity investments and crediting cash for the purchase price of $10,000. Next, we journalize the receipt of the dividends on August 1st, 2018 by debiting cash and crediting dividend revenue for $400. To dispose of the investment on August 31st, 2018, we would debit cash for the sales amount of $10,450 and we would credit equity investments for the cost of the investment, $10,000, and credit gain on disposal for $450, the difference between the cost of $10,000 and the sales price of $10,450. The net effect of the investment on Bark's net income for the year ended December 31st, 2018 would be $850, equal to the dividend income of $400 and the gain on disposal of $450. On January 1st, 2018, Bryant Inc. decides to invest in 3,750 shares of Farrier stock when the stock is selling for $16 per share. On August 1st, 2018, Farrier paid a 70-cent per share cash dividend to stockholders. On December 31st, 2018, Ferrier reports net income of $50,000 for 2018. Assume Ferrier has 15,000 shares of voting stock outstanding during 2018, and Bryant has significant influence over Ferrier. First, the problem asks that we identify what type of investment the Ferrier stock is for Bryant. Since Bryant purchased 25% of the stock of Ferrier, this would be an equity investment. The entry to journalize the purchase of the Ferrier stock by Bryant would be a debit to equity investments Ferrier and a credit to cash for $60,000, which is equal to the purchase price of $16 per share times the 3,750 shares. To record the receipt of the Ferrier dividends by Bryant, we first calculate the amount received, $2,625, by multiplying the 70-cent per share dividend by the 3,750 shares owned by Bryant. Then, to make the entry, we debit cash and credit the equity investments Ferrier account for the $2,625. Next, we will record Bryant's portion of the net income of Ferrier on December 31st, 2018. Bryant would debit equity investments Ferrier and credit revenue from investments for $12,500. This is 25% of the $50,000 net income that Ferrier earned in 2018. The problem then asks in what category and at what value would Bryant report the investment in Ferrier on the December 31st, 2018 balance sheet. This investment would be reported in the long-term assets portion of the balance sheet at $69,875. To determine this amount, we take the original cost of $60,000, subtract the dividends received of $2,625, and add the $12,500 income that Bryant reported for the 25% ownership in Ferrier's net income. On February 1st, 2018, Bell Company decides to invest excess cash of $16,800 by purchasing a Grant Inc. bond at face value. At year-end on December 31st, 2018, the fair value of the Grant bond was $19,600. The investment is categorized as a trading debt investment. To journalize the investment by Bell Company in Grant, we would debit trading debt investments and credit cash for $16,800. On December 31st, 2018, we would record an unrealized holding gain on the trading securities since the fair value of the Grant bond increased to $19,600. To determine this amount, we subtract the cost of $16,800 from the fair value of $19,600 and we get $2,800. We record the adjustment in the investment's fair value by debiting fair value adjustment trading and crediting unrealized holding gain trading for $2,800. Next, the problem asks in what category and at what value would Bell report the asset on the December 31st, 2018 balance sheet. In what account would the market price change in Grant's bond be reported, if at all, and what is the net effect of the investment on Bell's net income for the year ended December 31st, 2018. The investment in the Grant bond would be reported in the current assets section of the balance sheet at the market price, fair value of $19,600. The market price change in the Grant bond would be reported, and it would be in the unrealized holding gain and the fair value adjustment accounts at $2,800, which is also the net effect of the investment in Bell's net income for the year ended December 31st, 2018. On June 1st, 2018, Josh's Restaurant decides to invest excess cash of $54,400 from the tourist season by purchasing a Jackrabbit Inc. bond at face value. At year-end, December 31st, 2018, Jackrabbit's bond has a market value of $51,200. The investment is categorized as an available-for-sale investment and will be held for the short term. The problem asks that we journalize the transactions for Josh's investment in Jackrabbit Inc. for 2018. First, we will record the investment purchase by debiting available-for-sale debt investments for $54,400 and crediting cash for the same amount. Next, we will record the fair value of the securities at the balance sheet date. The problem states that the bonds have decreased in value from $54,400 to $51,200 at December 31st, 2018, resulting in an unrealized loss of $3,200 on the Jackrabbit bonds. To record the fair value adjustment, we debit unrealized holding loss available for sale securities for $3,200 and credit fair value adjustment available for sale securities for the same amount. Next, the problem asks, in what category and at what value would Josh report the asset on the December 31st, 2018 balance sheet? In what account would the market price change in the Jackrabbit bonds be reported, if at all? And what was the net effect of the investment on Josh's net income for the year ended December 31st, 2018? The investment in the Jackrabbit bonds would be reported at the fair value of $51,200 at December 31st. The investment would be reported in the current assets section of the balance sheet. The unrealized holding loss in the fair value adjustment accounts would report the decline in the market price of $3,200, but there would be no net effect on Josh's net income because the unrealized holding loss is reported in other comprehensive income, which is part of stockholders' equity and not in net income. This is the conclusion of the demonstration for the exercises for Chapter 10.